In last video, we learned the difference between financial reporting and tax reporting, which is caused by the permanent and the temporary difference. In this video, I'm going to use a very important tool, accounting equation, to make you understand the difference deeper. And according to the US GAAP and IFRS, so when company compute their income tax expense in the financial reporting, they should exclude the permanent difference. So basically, the difference between financial reporting and the tax reporting is a temporary difference. Now, so this is the accounting equation, right? Assets equals to the liabilities and the stockholders' equity. When company report their tax expense, so we are going to record tax expense. And also, when company pay tax, we are going to decrease the assets, which is a cash outflow. We know there's a difference between these two items. Right? To make this accounting equation balanced, we should make the adjustment. Actually, we recorded the difference into two different accounts. One is deferred tax assets. The other is deferred tax liabilities. And if we write their relation into an equation, so this represents the same thing. Income tax expense equals to the income taxes on taxable income with the changes in deferred tax liabilities and changes in deferred tax assets. Okay, so deferred tax assets is an asset account. Okay, so the temporary difference can increase or decrease this account. Deferred tax liabilities are also accounts reported or report in the liabilities. So some other temporary difference will affect this account. Let me use the prior example. So right now we do not consider the permanent difference, the $25 interest on municipal bonds. We just focus on the temporary difference in depreciation and warranty. Okay, in the first year, the financial statements report $60 depreciation expense, and the tax reports report $80 deduction. So actually, same revenue, but tax report deduct more. Right, so this will reduce the current taxable income, and again, will reduce the current tax payable. But we know that's temporary difference finally will be reversed, right? So actually, the $20 difference will be considered as a future taxable income. Why? Because you deduct 80 rather than 60, so you reduce current taxable income, but you will increase the future future taxable income. So in other words, the company deferred their tax payment in their tax reports. So we consider this as a taxable deferred tax liabilities. Okay. Warranty. So the tax report is 4, while financial reports is 10. So actually, this will increase the taxable income because 4 is less than 10. And its effect will increase the tax payable. But we know this effect will finally be reversed, right? So it is considered the future tax deductibles. Although right now in this year deduct less, but in the future you're going to deduct more. So this is considered future deductible. The effect of future deductible results in less tax payments. So it is considered deferred tax assets. So if I use numbers, so the tax expense regarding this example is 52. Okay, it reduced stockholders' equities, so negative. And the cash outflows is 46.4. It's the actual payment to the government. Again, it is also negative. Okay, but this is not balanced. As I said, the $20 depreciation expense will result in deferred tax liability. So deferred tax liability will increase. But don't forget, now 20 you should multiply the effective tax rate 0.4, result in the $8 deferred tax liability. And the warranty expense, the $6 difference is considered as deferred tax assets. So deferred tax assets increase, the difference is 6 multiple 0.4 equals 2.4. Okay, let me move it to the liability. Okay, so right now on the left hand side, the total assets is negative 44. Right. On the left hand side, it is negative 44. So accounting equation is balanced. Okay. But you know this will be finally reversed. Okay. So if we put into this equation, the income tax expense is negative 52. It equals $46.4 and plus 2.4. Oh, we should subtract because the 8 is increase deferred tax liability. So we should add 8 and increase 2.4 deferred tax assets. So increase should subtract 2.4. Let me switch to the another PowerPoint. Okay. Results in deferred tax assets. Future taxable income result in deferred tax liability. Okay, so it is hard in the beginning because so many terms and it's very confusing to remember or to understand them. But you need to repeat again and again. Finally, you will find it is not that hard. Like this one, the future tax deductible, which is good for the firm, right? So it will deduct the future tax payment. So it is considered future benefit. So it is deferred tax assets. And future taxable income, we know the company is going to pay more tax in the future, right? So it will result in the future payment, which is liability. So it is for tax liability.